Good afternoon. Thanks for joining us. We're going to go ahead and get started in just a few moments.
For our market update and year-end tax strategies. Today, as always, we'll be going over the market, economic data, as well as positioning of the portfolios. At the end of the call, I'm going to share some year-end tax strategies to look or review with your advisor. Hope you're all having a good week. Hope your families are all healthy and safe. We're all getting ready for and to cope with this maybe an extra spooky Halloween weekend as we celebrate Halloween during the pandemic, which is certainly going to be different like many things. I know I was sharing with Cliff a little earlier. My wife Shannon and I had our 25th wedding anniversary, and it was not in Paris. It was not on a beach. It was in our house with our children, celebrating a nice anniversary, 25th anniversary dinner. So it's just different times that we're in. First, want to welcome Cliff, our Chief Investment Officer, as always. Thanks, Cliff, for joining me today. Hope you're well.
Yeah, Jeff, great to be with you, and congratulations. That's quite an accomplishment.
Thank you, Cliff. Of course, I'm Jeff Carbone, one of the managing partners at Cornerstone Wealth. I'm going to, with the World Series now in the books for the year, just the LA Dodgers bringing home another championship to LA the last evening. I'm going to use a little bit of a baseball analogy. We're rounding third here, and we're heading home to the finish of 2020. In many cases, we're going to say, thank goodness. Whatever else we want to say, many things can be said. 2020 has been quite a year. I'm going to maybe just share some economic forecasts that we've been looking at. GDP did come in this morning, came in a little bit better than expected. We had a big run at 33.1 for Q3. We have still an estimate for 2020 of a negative, probably negative 4 as estimated at this point. We're continuing to see interest rates remain low, 10-year note below 1%. We're watching and seeing mortgage rates below 3. Inflation excluding food and energy about 1.9. Watching oil trade around 40, and unemployment rate averaging about 7, still a high 7.5. We all know we're less than a week away from Election Day, and many things continue. We continue to wonder if the elections will make or break the markets and the economy. We know how contentious this election cycle has been. And for many folks, no matter who you're voting for, the victory for the opponent will be damaging to the markets. Historically, that is not the case or conclusion. Politics and policies do matter, but it's better for investors to watch what politicians are doing versus what they're saying. We should certainly prepare and seek to be informed, but it's better to formulate an investment thesis once policies are known and appear to be enacted. Volatility also continues over the past week as the fear increased with rising virus cases in the U.S. and abroad. Concerns of with the impact of new lockdowns and how that could lead to a lower consumption by consumers. The rise in COVID cases, along with lack of Washington, D.C. coming together on additional stimulus, has really taken away from a focus on earnings season, which we're now in the midst of a big week, and the next couple of weeks being pretty big from earnings perspective. The data continues to come in for the third quarter, and the markets and the economy still remain a bit disconnected, which is not unheard of, but the markets have been pricing in a pent-up demand from the consumer, a pandemic-induced economic impact waning, and lots of liquidity running through the capital markets. That kind of changed a bit over the last week or so. So Cliff, let's jump in and let's start discussion on the markets, the economic data, and the positioning of our portfolios.
Thanks, Jeff. And before you go radio silent, just want to make sure you can see the presentation there.
We are all set.
All right, good deal. Well, thank you for joining us, everyone, and we'll get started here as we typically do with a brief review of the broader markets, starting with the S&P 500. So you look at this chart going back a year, and man, what a year it has been. From the COVID-induced shutdown, the fastest bear market on record, 35% drop, followed by a 64% rally for reopening and stimulus, and about an 8% pullback from the September highs on virus and election jitters. It has really been quite the ride. Quick update on valuations. Even though we have seen a bit of volatility here over the past, we'll call it a couple of weeks, or really month to date, we are still pretty overvalued from a price to earnings standpoint. Looking at next year's estimates, while the froth has come off a bit, we are still really overvalued when you look back over history. A quick check on sectors and style factors. As we can see here, the S&P 500 as of this morning is up about 5% year to date. Only 3 out of 11 sectors are outperforming. So that's technology, discretionary, and communications. Whereas 5 sectors are actually still negative. So about half of the S&P 500 sectors are still negative year to date, including a lot of the cyclical components of the market. Very similar story from a style factor perspective. If you haven't been in growth and momentum, you've underperformed for the year, with certain areas of the market still down over 20%. Just again goes to show how narrow and concentrated this rally has been. And as I mentioned, the most recent bout of volatility has really been driven by a couple of things. One, and most importantly, we have seen an uptick in coronavirus cases, COVID-19. New records here in the U.S., recent shutdowns overseas in Europe, France, and Germany, partial lockdown in the U.K. as well. But a bit of a silver lining here on the right-hand side, while cases are spiking and we're seeing the moving averages of those bounce, the rate of fatalities is actually diverging in a positive direction. So cases are spiking, but deaths are not at this point, and we hope and pray that they remain low as we continue to navigate. And we've gotten much smarter about the virus, treatments and therapeutics, and hopefully we'll be in line for some positive news on vaccines, with some readouts from some of the major players here in the U.S. expected next month. The other 800-pound gorilla in the room as it relates to overhangs in the market is the election. Just providing a brief update on both the betting odds as of this morning, also a look at the national polls according to The Guardian. They aggregate a handful of the more national polls, still showing a lead for Biden. But interestingly enough, much like we saw in 2016, a bit of narrowing here as Trump has gone up to about 42.5%, and Biden has come down a little bit. But that's the national level. When we look at some of the swing states, Florida, Arizona, North Carolina, Pennsylvania, a few that people are really focused on, you can see that it's really much tighter at the state level. And in fact, a lot of these are within the standard margin for error. So, we're certainly going to be in for an interesting election night and election period. And I say period because one of the additional features of the COVID presidential election is the amount of mail-in ballots. So this, according to the New York Times, we've got nearly 80 million ballots already having been cast for the 2020 election. That's over 56% of votes from the 2016 election, and over 50 are mail-in to this point. And that is really important because of the likelihood or the probability, which we can see down here in the bottom half of the slide, according to Morgan Stanley. The probability is that we're not going to know the results of the presidential election on election night, coming in at about a 35% chance. And really driven mainly by this mail-in piece. A lot of states, including Michigan, Pennsylvania, and Wisconsin, some of the major swing states, actually do not allow for counting of the mail-in votes until after the polls close. So the thought is that we will find out the results during election week, 1 to 3 days after election night, with an outside chance of contested election, which may have to work its way through the courts. We're really hoping that outcome does not happen. As we all know, markets hate uncertainty, and so if there were to be a contested election, that would certainly add to some volatility. So Jeff, given all the mail-in voting, have you gotten your votes in?
Yes, Cliff, I didn't do mail-in, but I did early voting down in the town hall here in Cornelius. So I've done my voting, did my American deed.
That's great. I'm one of those 50 million mail-ins, so hopefully they'll get it.
Cliff, when you talk about when you look, I think we were talking earlier, and is it over 80 million early voting is already been in place, which I think accounts for almost half of the expected voting for this election cycle. So it's quite an extensive number that have already placed the vote in place. So a lot going on. So why don't we jump ahead, Cliff, and kind of start going through some of the economic data that you've been following and watching.
Thanks, Jeff. And you mentioned in the kickoff, we got the first read on the third quarter GDP number this morning. And see the tagline, "The best follows the worst." That's a bit of an homage to Brian Needleman, who was a mentor of mine and founding partner of Cornerstone. He would often say that within the equity markets, the best follows the worst. And that seems to be true here as well from a GDP and economic standpoint. As last quarter, the economy contracted by 31.4%, worst quarter on record, followed by a 33.1 number this morning, one of the best on record. So certainly an encouraging sign, as it did come in ahead of expectations. From a nominal standpoint as well, we can see that we were running at 21.6 prior to the COVID-induced lockdowns. We had the sharp downdraft in GDP and have bounced quite favorably here. So this is certainly positive news, and we're certainly trending in the right direction. But our models are actually indicating that from here, it's going to be a bit of an uphill battle. As we look at our model going out over the coming quarters, a bit of a tougher slog here for the next 2 quarters before finally inflecting positive in second quarter of 2021. So certainly moving in the right direction. As we'll discuss, there are some exogenous factors that potentially open up a pocket of risk here as we move into year end. So certainly some things that we'll be continuing to monitor. From a business cycle perspective, as we can see from the previous chart, we have gotten past the worst of it, past the lows, continuing toward that early cycle recovery phase, but just not quite yet, not quite out of the woods yet and ready to make the call that we are in that recovery phase, but certainly will be coming as we continue to navigate. We get an update here as well on the New York Fed's weekly economic index, which again is an index of 10 high frequency economic data points. Very similar pattern to what we saw in GDP, as you had this sharp drop beginning in March, and we're continuing to work our way through recovery. But really the risk here is that, and what we don't want to see is any sort of slowing momentum. We've talked frequently on prior calls about the effects of fiscal stimulus, and now that those will begin to wane and roll off. In fact, Good Judgment Project, which our clients may or may not be familiar with from the book Super Forecasters, actually are not predicting a stimulus bill of more than 750 billion passed into law prior to January 2021. So if that were in fact to be the case, it's likely that folks would not get the cash in hand until late February, early March. That's quite a long time between now and then, where the economy could certainly worsen. So that's one of the key risk factors that we're calling out, in addition to potential resurgence of the virus, potential contested election that has got us positioned the way that we are, which we'll talk about here momentarily. Shifting quickly to an update on earnings. We are about halfway through earnings season, and actually just have had some really big names report after the bell. Apple, Amazon, Google, and Facebook all releasing results here while we've been on the call. So I'll certainly have a bit of a busy afternoon and early evening getting caught up. But the bad news is that both sales and earnings are down year over year. But the good news is that they're improving quarter over quarter and are actually beating estimates quite handily. So you can see from an earnings perspective by sector, the green is the percentage of constituents that have reported to date that are above Wall Street analysts' estimates. Yellow is in line and red is below. And so we can see overwhelmingly that results are coming in better than expected, which is certainly good when we think about the valuations and the price to earnings ratio. Having that E move higher will continue to help alleviate some of the overvaluation. And then more importantly, this is a chart highlighting management guidance. And it goes back to 2000, but the good news here is that we actually have maybe never seen guidance this strong ever relative to what the market has been expected. So really the theme and the takeaways here, Jeff, is that things are certainly continuing to improve at the margins. There are risks here in the short term, which we've highlighted and we'll continue to monitor. But we're getting more and more constructive on first half of 2021, which we'll talk about here a bit further.
Had to put off my mute. Sorry about that, Cliff. Well,
All right.
you reviewed the economic data. You mentioned the best following the worst. It's good to see and hear that, again, things are continuing to improve, not out of the woods, but improvement. And positive momentum is about. We'll certainly, and like you mentioned, I think I did just looking down at my phone. They had Amazon came in, Facebook just as we're on the phone. So we're going to have a busy night ahead of us. Want to remind for everybody on the call, if you do have questions, please go to the send them in and we'll respond to them at just a few minutes. So any questions that you have on the markets, economy, or what our positioning is, that Cliff will go over in just a minute here. So Cliff, I'm going to throw it back to you and let's talk about positioning of our portfolios.
Absolutely, Jeff. And I do just want to take a moment to point clients toward a written quarterly update, which Ashley sent out. We posted to the website on October 15th under the Insights tab. Goes into a bit more detail along the lines of what we're going to be talking about today, with our views toward year end, positioning, so on and so forth. But really the main takeaway is that in our view, the market has really reached an important crossroad point going into year end, which is really going to set us up for a binary outcome, one way or another. We think the moves could be quite significant. So on the one hand, in the positive outcome, we get some movement and in fact do get some additional fiscal stimulus turned into law. We have a straightforward outcome for the election. Either way, we just avoid any sort of uncertainty. And then we get positive news on a vaccine. If those things all line up and the stars align, we could see another 8 to 10% run into year end as as optimism really takes over and people get excited about reopening and the economy getting back together or getting back on track. That's the positive view. The negative outcome is for a potential stalemate in stimulus, which unfortunately is looking more and more likely, accompanied by a contested election result where it has to work its way through the courts, and we don't get any information on who is going to be the next president or what the makeup of the Senate is going to look like, until much later in the year. Along with the resurgence of the virus, which unfortunately we're seeing cases all spike here. So given the uncertainty, given the valuation levels in the market, which we've called out prior, we actually think the risk reward is skewed to the downside in a negative scenario. We could be looking at anywhere from 10 to 15% from here. So that's really what we're seeing in the short run, right, from now until year end. But as I mentioned, we are certainly more constructive on 2021, especially the first half of 2021, as GDP in all likelihood is going to inflect positively year over year. Remember that rate of change, not the absolute level, but are we getting better or worse, is really what our models, what policymakers, and what the markets, in fact, really care about. And so given that outlook, and given that the markets tend to be forward-looking mechanisms and will discount the future, once we get through this pocket of uncertainty, we should begin to see the markets start pricing in a cyclical recovery more and more is the view. So what this means for year end is that we're going to continue to maintain our quad 3 exposures. Again, that's the barbell. So we've talked about that quite a bit, which is a balance between offense and defense, between growth and low volatility, which you'll see in some things like our technology overweight next to overweight in utilities, but importantly, underweight things that underweight the cyclicals like financials, like materials, so on and so forth, like small caps, like value from a factor perspective. So we are also maintaining a tilt toward quality. We do have a little bit of additional cash on hand on the equity side, so that we think that positions us well if we do get a continued pullback. We would view that as a buying opportunity, where we get the setup is a bit more conducive to this quad 2 type of scenario in early 2021. Now, Jeff, that being said, while in that kind of scenario where we're playing it a bit more on the conservative side with our equity portfolios, that would mean outperformance in weak markets, but the trade-off there is that would likely mean a bit of underperformance on really strong days, like we saw today. We look good for the month. We're likely a little bit underweight on a strong rally day today, but again, given the market environment, given the valuations, given all the uncertainty, we're okay with this trade-off in the short run. But the other thing I'll mention lastly before we finish up and I send it back to you is that especially in our more tactical portfolios, in anticipation of this quad 2 pivot, you may see us start to begin to dip our toe in a little bit of the more cyclical areas, like consumer discretionary, like energy, potentially some financials. But I want to emphasize that this is going to be gradual, and we may do a bit of trading around, as the market walks a bit of a tightrope here into this window of risk in the short term. But again, moving in the right direction, getting more constructive, I think are the major takeaways. So with that, Jeff, I will, good reminder on the quad view, quad 3, quad 4, risk off, quad 1, quad 2, a bit more constructive. So that's really what we're watching. Back to you.
Yeah, thanks, Cliff. And going back to the quads, like you said, you can look at the one side as quad 1, where the best risk on, meaning best opportunity to make money given the equity markets, i.e. at 2019. As I mentioned earlier, it didn't matter what you owned, you basically made money. Just the amount of money you made was different if you had technology versus if you held utilities. So again, we're in that quad 2, 3. We're really quad 3, but kind of when that tilt goes to quad 2, and that's like you mentioned, that's what we're looking at. How do we start touching the waters, but being cautious because we don't have all clear at this point. So, Cliff, we do have a question. This is again, some of this question I think from Ed goes to a little bit of emotion. And Cliff, so what plans do you see for investors? What investors should take if Joe Biden wins? And do you see very little hope in my current investments? First of all, we don't see very little hope. That is, we take a long-term view, Ed, on the scenario. This is, again, it's emotional, right? This is, like I mentioned earlier, it's a contentious election cycle. So it's a very emotional time. Historically, things tend to work their way through. There's a lot, if you did not join or weren't able to join on the governmental call that we had discussing market conditions under Republican-led Congress, Senate, and presidency versus split Congress versus democratically led, fully led, all scenarios, they all look a little different. So Cliff, I'm going to just throw that to you for a second. Any other thoughts you have on that question?
Yeah, and Jeff, I think you did a great job with it. I would certainly point our clients toward the call that we had with Fidelity. It's available on the website. We can certainly get a link out to you. But the main takeaways are that there certainly could be some volatility based on the results of the election. More importantly, to us, we are regardless of the outcome, are going to stick with our process, because in the short term, election results can cause some noise. In the longer term, what really drives markets are these rates of change and growth and inflation and ultimately policy, right, in the form of Fed action, fiscal action, so on and so forth. So, there are things that we are gaming out kind of behind the scenes, below the surface level, just of the broader markets. Some areas that would do well in a Biden or a blue wave scenario, areas that may do well under a split ticket, areas that may do well under an all red scenario. But the key takeaway is that these are pivots, not wholesale changes that we're going to make to our investment strategy or to allocations, because in the long run, they typically tend not to matter.
Well, Cliff, I think as we do in all the webinars, we share a lot of information and certainly want to lead everybody back to the quarterly update. Going back to that question, we want to remind, again, a good reminder to all clients as investors, we're increasingly lured to make decisions based upon emotions. And this is an emotional time more than facts. You've heard us many times discuss fear and greed. We want you to, we got to be careful and try to avoid the traps from when the investment or political environment feels uncertain. It's important to increase our efforts to make decisions more based upon the fundamentals and what we know about the markets from history, right? The 3 Ps that we continue to preach, planning, process, and patience, they are more important than ever. They continue to be as important as they have ever been. I'm going to spend a few minutes, and again, as I mentioned earlier, we're probably going a little bit over time today, but want to close our call today with some tax ideas and some strategies from a planning perspective. So again, just some ideas to look at as we are coming to the end of October. We now have 2 months into the remainder of the year, and a lot of these strategies have to be done before year end. So number one, if you are working and you have earned income, make sure you are maxing out your 401k or your IRA or any type of retirement plan that you own. In the height of the pandemic in March and April, I know I had a few clients, or we had a few friends, and talk about how they were going to lower their 401k contributions going in. If you did, take a look back, make sure you are on track. If you're able to able to put away that 19,500 for the year, which hot off the presses, contributions for 2021 will remain at 19,500 for the year 2021 as well. Another reminder in terms of contributions, if you're over age 50 and you're contributing to a 401k, make sure you're taking advantage of the catch-up provision, which allows you to put another $6,500 away. And for your IRA, again, making your additional $1,000 contribution if you're doing an IRA account. Another reminder is part of the Secure Act, which was passed a few years back, allowing those over 70 and a half and who are still working and have earned income to allow you to contribute to retirement accounts as well as contributing to an IRA, which we weren't able to do prior. So making sure you're looking at those opportunities. Another number 2, required minimum distributions. With the passing of the CARES Act earlier back in March, RMDs were not required for this year. So if you were 72 or over, not 70 and a half, part of the law changed, the Secure Act changed the age to 72. But if you're over 72 and you had been taking your distributions, you're basically getting a pass for 2020, and that's including inherited IRAs and other retirement accounts that had required minimum distributions upon them. But I'm going to say, depending upon your tax bracket, we know the tax brackets today. We don't know what they will or could change to in the future. So depending upon your tax bracket, you may want to take advantage and look at taking a distribution, even though it's not required. And it will not be a required minimum distribution. It would just be considered a distribution. You may still want to talk with your advisor on a discussion on taking that distribution. Or I think even better discussion may be on the ability to do a Roth conversion for this year. Use those funds that maybe you typically would have been required to take out, but convert those to a Roth IRA. A Roth IRA is, again, totally anything you keep in there. If you have an IRA that's over 5 years, it's totally tax-free. If it's a new Roth and you keep it in there for 5 years or longer, any of the whole account will be tax-free, including the appreciation of those funds. So make sure you're taking a look at what opportunities Roth conversions can bring, again, knowing our tax brackets today. Number 3, let's talk about charitable giving. Anyone and everyone this year, whether you itemize or not, as part of the CARES Act, you can make a $300 contribution to a charity, and it is considered an above the line deduction, meaning, again, you do not have to itemize to take that $300 deduction. So if you're giving to your church or charities, no matter whether you itemize or not, you will be able to take a $300 distribute or above the line deduction. If you do itemize and you're on the cusp of itemizing your deductions, always consider bundling your deductions in a year for those charitable contributions, and you could be allowed to itemize, again, if you're on that cusp, just other ways to look at. Another thing, when you're making those contributions or to charity, look at gifting of appreciated longer-term stock or investments versus cash. A lot of opportunities there and planning opportunities go on. Lastly, regarding charitable giving, if those who are 70 and a half, even though, again, as I mentioned, RMDs are not required, qualified charitable distributions, or what we call QCDs, are allowed. You are allowed to make contributions from or donations from your IRA, and it is non-taxable to charities. There is a maximum gift. It's $100,000 for the year, but again, pretty sizable amount that can be given away on a tax-efficient basis. Next, number 4, tax harvesting. As a part of our Cornerstone investment team and committee, we've already done a fair amount of tax harvesting. Harvesting is some of what a fall type of thought. Many people in the fall, or many investors in the fall, look to see what gains and losses they have. Again, take a look at your gains and losses to find strategies to offset those gains that you may have, or to utilize the losses that you may have in your portfolios. Again, just like I mentioned, tax rates could change. That means capital gains rates could change in the future as well. Also, we are not, if there's outside accounts that clients are holding, we're not always aware of any gains or losses from those outside accounts. So it's, again, a great time to discuss with your advisor any gains and losses that you may have in your portfolio. If you do have, we've had a couple clients we've discussed this with that have had large capital gains from the sale of a business or sale of a property. Another opportunity to consider is what's called an opportunity zone. And opportunity zones, there's over 8,000 throughout the United States. They allow you to defer taxation until as late as 2026. And if the investment is held for over 10 years and all rules are satisfied, you're eligible to pay no taxes on the appreciation of the investment in that opportunity zone. So again, other scenarios to look at. Lastly, and I'll wrap it up here, is just a reminder that with the potential tax law changes, there's also potential for estate tax law changes. Continue, if you're able to, gift on that annual basis, the $15,000 per person. Could be to a 529 plan, could be to a trust, whatever. Continue to look at utilizing the annual gifting strategy. Or even more effective, we know what the estate tax laws are today. Consider looking for opportunities to use your lifetime gifting opportunity. And I say it's an opportunity because it's there currently. We're also in a very low interest rate environment, so look to leverage in estate strategies that take advantage of the low interest rate environment. Jarrett DiMarzio and I held a estate webinar a few weeks back, and we discussed strategies such as spousal lifetime access trust. We discussed grantor annuity trust. We discussed intentionally defective grantor trust, IDGITs. We went over quite a few scenarios where we're utilizing the low interest rate environment today. So again, just a few ideas I wanted to share with you all. We want to thank you for your time today. Thanks for joining us. If we could be of any assistance, please don't hesitate to reach out to your advisor, reach out to Cliff or myself. We'll certainly get you any answers. As Cliff mentioned earlier, go to our website if you would like to read or share our investor commentary and quarterly update. Pull that off the website under the Insights panel and read that, share it with your friends and coworkers. Of course, we'll have a follow-up call after the election or soon thereafter to kind of review any updates in the markets, any updates we're seeing in the economy, expectations or changes ahead for portfolios. Our job is to keep you well informed, and we'll continue to do so. Want to wish you all a good weekend. Be safe this Halloween weekend. Continued health and wealth to all. Want to thank you all for joining us. Be safe and healthy, and wear your mask, everybody. Thanks,
everyone. Happy Halloween.
And Halloween. Oh, we got a couple more questions that come in here too. I think this is maybe a continuation of the earlier. Just do we see the market plunging? Either way, let's say do we see a major correction in the market? Either way, with Biden or with Trump win, or a Biden win? Either way.
Again, kind of goes back to what we hit on earlier with some of the pockets of risk. The main one around election is that we get a contested result, right? We don't want uncertainty. We want to know fairly quickly who the winner is, so that the markets can reposition accordingly.
Gotcha. Perfect. And Cliff, I like your Halloween background. I didn't see that for a second. I thought you were at your house.
I was waiting for you to tell everyone Happy Halloween, Jeff.
We will say Happy Halloween. We'll sign off here. Everybody be safe and healthy, and we'll be talking to you soon.
Thanks.